Over the last couple of years, it's been interesting to watch how the software industry has really become, in a lot of ways, the software as a service industry. It's the most dynamic topic in the technology industry today because that's where the edge of innovation is taking place. If you pick apart the old technology stack and look at sort of the middle of the stack, virtualization, systems management, grid computing, that's really what cloud computing has become. The top of the stack is where software as a service and automated processes and workflows are really garnering a lot of attention because of ease of use, user acceptance, and stickiness. So as it relates to how the marketplace has shaped itself now, looking back at 2006 when Salesforce.com became a force that drove Cisco to acquire WebEx, it forced IBM, SAP, Oracle, and Microsoft to get real serious about their software as a service or software plus services messaging. It allowed emerging vendors to think about how they wanted to price their services, how they wanted to attack some of the more discrete disciplines that existed in different domains and verticals, and that's really what we have today. We've got cloud computing as the base layer, where you've got enablement technologies with emerging firms and large platform opportunities with global firms, and then the software as a service businesses continue to try to figure out how to monetize and grow and scale their businesses. As it relates to funding, there's a lot of bootstrap businesses that are successful, and we're encouraging them to try to minimize the potential dilution that they would get from raising further venture money. If you've got venture money today, what we tell you to do is try to hunker down, get profitable, exist on your current cash flow, and if you do need to raise money, shop around, look for the best terms you can possibly get to accentuate that growth, and try to know that if you're going to raise money, you're going to have to make that last for 2 or 3 years if you're not close to profitability yet, because you may not get another round in this current venture capital environment. If you're finding an exit, our advice right now, or if you're thinking about finding an exit, our advice right now is to don't think 2 or 3 years out and think, well, maybe I'll get to an IPO, because the IPO dynamics are going to change quite dramatically. It costs upwards of $2 to $3 to $4 million to be a public company today, which can really crush the bottom line for a lot of businesses. We think what makes sense is to be opportunistic. If you think an acquisition in 2 years might take place, you might have someone show up on your doorstep tomorrow that's willing and interested in paying you potentially a strategic premium to capture your IP and bring it into their channel and really help you realize your vision a lot more quickly. So what we're doing as an advisor, as CEOs and boards call us, is help them think through what you would do if you did get an over-the-wall solicitation, or what would an actual fair value for your business be, and then how would you take that fair value and benchmark it against other comps that are taking place in the marketplace. Lots of dynamics happening. It's a unique skill set for CEOs today with cloud and with SaaS. We think it's a services skill set more than it maybe is a product skill set, and that sort of plays into the dynamics as well. So looking ahead, we think cloud is going to be a huge driver from an infrastructure standpoint. We think SaaS is a component to cloud, and we think that valuations are going to be based on growth optics and profitability optics, and we're probably now away from the market we were in a year and a half ago, where it was all on futures and all on sort of pie in the sky growth. We think those days are gone. There's a lot more scrutiny now around valuations.